You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, good morning, Jim. Good to be with you.
We started off the year with horrible equity markets plunging like rocks falling out of an airplane. Then they perked up, but now you're saying all those gains that we made after that plunge, not there anymore?
Well, no, they're topping, and it may take a few months to erase all the gains, but at any rate, the markets became extremely oversold in January, sort of focused in January, and of course that was tied to weakness in commodities and more specifically to crude oil, which can set a seasonal low in January, which it did. And I want to go back to 2014 when we were looking for crude oil to rally up until June of that year. It did get to, I think it was 107, and then we were looking for it to fall to 1/3 or 1/4 of that high, and the 1/4 of the high the calculation was 27, and the low was 26, close enough. Anyways, the rebound in crude oil was pretty good. Got up to 42, I think it was. The other one that was really good that you don't see, you have to look hard to find the quotes, and that was the iron ore contract, which had been an absolute disaster. And it rallied up, huge rally, and a week ago we had, actually it was 2 weeks ago on that one, we had, tremendous excesses, technical readings, upside exhaustions and momentum and all kinds of stuff. So it got peaked and got hit hard. It was down 10%, had a modest rebound and is now starting to weaken again. So it's similar to crude. The other one is base metals had a terrific rally as well, and base metal shares did very well. I mean, terrific. And so that was all good. But last week we were looking at the excesses. Like some of them had a huge swing from being very oversold in January to being quite overbought. And we were noting that, and basically on the rebound out of the January disaster, we were looking for it to go into March, maybe through, these are sort of 5 or 6 week windows when you can have the peak you were looking for, but it looks like it's done it here now. The other one is that in the last couple of weeks, we had weakness in the U.S. dollar, head down, and then last week it just gapped down and then came up and is rallying quite strongly. And this time the rally is associated with, weakening stock prices and weakening commodities, and also as part of the party on the way up, you had a terrific rally in junk bonds and high yield stuff. These things move very nicely. So this gets us, of course, to credit spreads, which is the difference between high grade bonds and low grade bonds, and that narrowing last year, we played that one down into May, June, and then the widening came in, reversed, and then in July we were looking for the chart of spreads to break out, and it broke out in late July, and then of course that triggered off the Shanghai crash and various other unpleasantries, and the first Shanghai crash ended at the end, late August. That was that August 24th, or Black Tuesday, they called it. Then you had rebounds into November, and then you had the very disappointing start of the year in the financial markets. and that more or less, as we noted, climaxed in January. So you look at these rebounds; they're terrific. They largely propelled by short covering, because the decline in December and into January was really quite relentless. And then I guess a bunch of late shorts were there and didn't see the cover as it bottomed, and then forced the covering on the rally. That adds a lot of dynamics to any such rally. And of course, we know that the Federal Reserve and other central bankers do try to play that game where they can force the shorts to cover, and they think it'll change financial history, but it's the same old, same old. Seasonal high in here for commodities. The big leading one was iron ore, and it set upside exhaustions and has taken the break. So here's the rest of them getting in line. It's going to pull gold and silver down with it, which also became overbought on the fun there. And, some of the gold indexes were up quite a bit.
We'll have more with Bob Hoye right after the break.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Bob Hoye. You've nicknamed the March-April period in the markets the sensational season.
Yeah, Jim, we used to call it the silly season, but that was looking after it was over, and you'd look, and I remember, in 1996, that was the year of that Bre-X huge gold stock promotion that was a fraud. Well, there were other things that just, in that March, stocks that went from sort of 10 cents to 40 cents. It was just incredible. So it's easier to say over your shoulder, looking back, and say, the silly season did this. But I think when you're looking forward to excitement in March, you can call it the sensational season, and it has been sensational because you've had, for example, all of a sudden, sugar taken off here, and it was 12.5 cents in February, and it made it up to 16.8 cents here, and overbought, even popped yesterday an inverse springboard, which is a sell. So these things are terrific to watch them. But the point is not to fall in love with the move and realize that at this time of year, you can have a number of items have seasonal highs, like base metals, and also looked at this sugar thing, and it can have good highs, spike highs up into sort of February, March time of year, which it seems to be doing now. So this then also pulled up, as we said, the price on junk bonds. Some of these rallies were terrific, and so we did one on high yield last week as being overbought, and the best of the move was in. And also on municipal bonds, the Muni contract is the MUB, trades well, and it had a terrific rally and right up to giving upside exhaustions and these very bold signals. So our interest in the municipals is that people in the States have a tax break on them, and they're also something that trades. But the counties and cities in the States have been very reckless. Many of them have been very reckless with their budgeting and with their unionized employees. They've ground out huge benefits on pensions when they retire. It's really a distorted system. So there are a number of cities and counties that have been excessive in this regard in budgeting and are vulnerable to the discovery of insolvencies. So the price action has been terrific on muni bonds, enough to generate all kinds of excesses, and for our U.S. listeners, it'd be time to get out of them. And then we want to move over and look at the golds. Some of the gold indexes, GDXJ, they were up 60, 70% from the lows in January. The price of gold had a nice rally in U.S. dollar terms, and this is maximized out. We advised last week to take some money off the table, and so the connection between gold and commodities here has been in favor of the usual gold bugs look, is that the dollar down, the Fed is evil, let's own gold. And then also the other thing, inflation is back, commodities are up, let's own gold, so let's own silver. So we think that's maximized, and we've had a very good run in the gold stocks, and a week or so ago we said it was time to take a little money off the table, and it's still not too late. But the thing to keep in mind is that these are extremely volatile times. Markets, when they're run by private individuals, can be volatile, but when you have central bankers who have some very arbitrary notions about what should be going on and can be extremely reckless in the amount of credit that they can provide, this is adding much to volatility that's going on. It's another way of phrasing it is that the markets, private markets, can become highly speculative all on their own. You've got a long history of that. And then when you're in a world where the central bankers have become highly speculative, and actually when I think about it, Jim, just the notion that a central bank can manage an economy is speculative theory. And then when they go out and try and do it, and or as I said, they become absolutely reckless, you've got a combination of private speculation and policymaker speculation that is without exception. It's never to this degree ever happened before. And decide that markets are markets, and the bid, the speculative bid can be all over the place. But I just thought of one other thing. As these commodities weaken and the dollar firms up a little, the U.S. long treasuries could be a good play. They're up on the week, of course, and the TLT can get up to that last high at 135, and then we'd take another look at it. So, Jim, it's been a very interesting week in the marketplaces.
Well, I saw the U.S. dollar is up, and so the Canadian dollar has fallen, not so much because of weakness in Canada, but just because the U.S. dollar's gone up so much.
Yeah, you heard that, but also keep in mind that your Canadian is tied to commodities. They started to slip from Friday highs, and then you had the government, Liberal government, come in with a budget, and all of the consumers of government services are going to be rewarded, and the taxpayers who ultimately pay for it, absolutely nothing for the ordinary taxpayer, nothing for small business, which provides about 70% of the employment. So it is a political document that's telling us where the federal government is going to go, and it will be in your face and in your wallet politics so far as the eye can see.
Why wouldn't they have helped the generator of 70% of jobs in Canada?
Hard workers, producers, the discipline of business, they don't really like. They want all emotions, and we have to help this person, we have to help that person. And this is an ideology that is very much part of the liberal left politics in any country, and particularly so in Canada, whereby the previous conservative government was attempting to bring back in the concept of a limited government And the left, which didn't like this, called it austerity. And then with the win by the Liberals, it is back on to big government forever, with very little ability. I mean, the checks and balances in a normal constitutional country are out the window. Checks and balances are provided by the media, which should be critical, but anything a big government gets support. The judiciary is supposed to be independent, but it's a bunch of liberals. The civil service, of course, is 95% socialist, and anything that they see that expands their power is wonderful. So we're back into same old big government again in Canada. But it'll be interesting because in the past where extreme experiments in authoritarian government have been conducted, they eventually run out of money, and eventually they run out of the ability to invent money through depreciation. So the perpetual motion machine for funding unlimited government, of course, will find a limit, and it might take a few years, and then we'll find some relief for the poor taxpayer as the concept of big government gets burned out. So, Jim, we live in very interesting political times.
Well, the fallout in Europe from negative interest rates is that insurers, banks, and pensioners are all in desperate situations. Lloyd's of London had a record loss because they can't make any money on the investments from their investors.
Oh, yeah, but you got to realize that with the politics of big government and currency depreciation and abuse of the credit market, the savers are not supposed to win anything. And, of course, when they go to negative interest rates, they're really penalizing the saver. So we can call it the ultimate in deliberate policy to turn the advantage to the bureaucracy and the disadvantage to the ordinary citizen who really wants to save a little money and build up some security, but the policymakers don't like that. So I think there'll be a tremendous clash of opinion on this. It's already appearing in the United States. In Europe, there's a clash of opinion between what the governing classes want to do and what the ordinary public wants. And the same thing is going on in Brazil. So this is the interesting part on politics, is that the public is beginning to realize that the governing classes want to do one thing, and it may not be practical. The last time this happened really big time was in the late 1980s, when in Eastern Europe, the ordinary citizen looked at the promises from the governing classes about how wonderful communism was and how wonderful equality was when they were living the good life with all kinds of perks, and the ordinary person was not doing so well under it. And the average citizen, East Germany, for example, took a look at it and said, hey, this isn't working. And they faced down a murderous police state, and that, of course, was climaxed when the Berlin Wall came down, which at the time was totally unthinkable. So here we have in, for example, the United States, the Obama administration for 8 years has been doing the legislative equivalent of building a Berlin Wall, and perhaps the reaction to it, as seen through the rise of Trump's popularity, is the beginning of in America, of a movement to dismantle the Berlin Wall that Obama has been building. It's going to be very interesting to watch that one. Pardon me?
But Trump wants to build a wall with Mexico.
No, yeah, I said that Obama was building a legislative equivalent of the Berlin Wall. And, of course, the Berlin Wall was built to keep people inside a bad system. And any wall, of course, it would be a metaphorical wall, would be to keep the criminals from Mexico out of the United States. No, quite a different story.
Bob, thanks a lot for chatting with us.
Always good to be with you. You have a good weekend now.
And you have fun with the Easter Bunny, too.
Yes.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network. You can forward questions or comments for the show to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.